In 2026, a familiar fear is returning to American households. The numbers are flashing again across television screens. Grocery bills are climbing. Gas prices are rising. Rent is stretching family budgets to the limit. After a period of relative stabilization, many Americans are once again asking the same uncomfortable question. Is inflation surging again across the United States? For millions of families, inflation is not just an economic term. It is a daily reality felt at supermarket checkout counters, gas stations, and monthly utility bills. In recent months, new data has shown price increases across several essential categories. While not yet at historic peaks, the upward trend is enough to trigger concern among economists, policymakers, and consumers alike. The story of inflation in 2026 cannot be understood without looking back at the years that preceded it. Following the global pandemic, massive fiscal stimulus packages were introduced to prevent economic collapse. Trillions of dollars entered the economy through direct payments, business support programs, and expanded government spending. At the same time, supply chains were disrupted across the globe. Factories shut down, shipping costs soared, and demand rebounded faster than supply could respond. The result was the highest inflation in decades. Prices surged across food, housing, vehicles, and energy. The Federal Reserve responded aggressively by raising interest rates at the fastest pace in modern history. Borrowing costs increased sharply, cooling housing markets, slowing consumer demand, and eventually reducing the pace of price growth. By 2025, inflation appeared to be moderating. Markets stabilized. Consumers felt cautious optimism. But as 2026 unfolds, new pressures are emerging. Energy prices are once again volatile. Global geopolitical tensions have disrupted oil production in certain regions. Supply constraints combined with strong summer demand have pushed gasoline prices upward. Because energy costs feed into transportation and production expenses, higher fuel prices ripple across the economy, affecting food distribution, manufacturing, and retail pricing. Food inflation remains particularly sensitive. Extreme weather patterns have impacted agricultural yields in multiple states. Drought conditions in some regions and flooding in others have reduced crop output. Livestock feed costs have increased. International commodity markets remain tight. These pressures translate directly into higher grocery bills. Housing continues to be one of the most persistent drivers of inflation. Although home price growth slowed during periods of high interest rates, supply shortages remain severe in many metropolitan areas. Construction costs are elevated. Zoning restrictions limit expansion. Rental demand remains strong, especially in urban centers experiencing job growth. As leases renew, tenants are facing noticeable rent increases. Healthcare expenses are also trending upward. Insurance premiums have risen in several states. Pharmaceutical costs remain controversial. For many middle-class families, healthcare represents one of the largest monthly financial burdens beyond housing. The Federal Reserve now faces a delicate balancing act. If inflation accelerates significantly, policymakers may consider maintaining or even increasing interest rates. However, higher rates can slow economic growth and raise unemployment. If the Fed tightens too aggressively, it risks pushing the economy toward recession. If it acts too slowly, inflation expectations could become unanchored, leading to even higher price growth. Inflation expectations are crucial. When businesses believe costs will continue rising, they raise prices preemptively. When workers expect higher living expenses, they demand higher wages. This wage-price dynamic can create a self-reinforcing cycle that is difficult to control. Consumers are already adjusting behavior. Surveys show households cutting discretionary spending. Restaurant visits are declining in some regions. Travel budgets are shrinking. Credit card usage has increased, indicating that many families are relying on borrowing to maintain living standards. Rising interest rates on credit balances add further pressure. Small businesses face their own challenges. Increased input costs reduce profit margins. Passing those costs to consumers risks losing customers. Many entrepreneurs report difficulty forecasting expenses due to unpredictable supply chain fluctuations and energy volatility. The labor market adds another layer of complexity. While unemployment remains relatively low, wage growth has slowed compared to previous years. In certain sectors, layoffs have increased, particularly in technology and retail. If job growth weakens while prices continue rising, households could face stagflation conditions, where economic growth stagnates but inflation persists. Global dynamics also influence domestic inflation. A strong U.S. dollar can reduce import prices, but currency volatility creates uncertainty. Trade relationships affect tariffs and commodity flows. Geopolitical conflicts disrupt shipping routes. The American economy does not operate in isolation. Political debate around inflation is intensifying. Lawmakers are proposing different solutions, ranging from tax adjustments and regulatory reforms to increased domestic energy production and supply chain reshoring. Critics argue that excessive government spending continues to fuel demand-driven inflation. Others contend that corporate pricing strategies contribute significantly to higher costs. For average Americans, the debate in Washington matters less than practical reality. Families are recalculating monthly budgets. Retirement savers worry about purchasing power erosion. Young adults struggle with affordability of housing and education. Fixed-income retirees feel particularly vulnerable when living costs outpace benefits adjustments. Inflation impacts different income groups unevenly. Lower-income households spend a larger percentage of earnings on essentials, such as food and energy, which are experiencing price pressure. Wealthier households may absorb increases more easily due to diversified income sources and investment gains. The psychological impact of renewed inflation fears cannot be underestimated. Consumer confidence influences economic momentum. If households anticipate worsening conditions, they reduce spending, which can slow growth. Businesses then delay investment, leading to reduced hiring and potentially weaker economic performance. At the same time, there are stabilizing forces. Technological innovation continues to improve productivity in certain sectors. Automation reduces production costs. Energy diversification, including renewable expansion, may eventually moderate fuel volatility. Supply chain improvements are gradually reducing shipping delays that once drove price spikes. The question in 2026 is not whether inflation exists, but whether the current surge represents a temporary adjustment or the beginning of a sustained upward cycle. Economists are divided. Some argue that recent data reflects seasonal factors and temporary energy disruptions. Others warn that structural imbalances, including housing shortages and fiscal deficits, could keep inflation elevated longer than expected. Financial markets are reacting cautiously. Bond yields fluctuate as investors assess future interest rate policy. Stock markets experience volatility, particularly in sectors sensitive to consumer spending. Gold prices often rise during inflationary uncertainty as investors seek hedges against currency erosion. For the Federal Reserve, credibility is everything. If markets believe policymakers remain committed to price stability, inflation expectations stay contained. If confidence weakens, volatility increases. Central bank communication, therefore, plays a critical role in shaping economic outcomes. Inflation is ultimately about purchasing power. When the same paycheck buys fewer goods and services, households feel strain regardless of technical definitions. In 2026, many Americans sense that pressure once again. Whether it intensifies or subsides will depend on policy decisions, global events, and consumer behavior in the months ahead. The story of inflation is still unfolding. The coming quarters will determine whether this surge becomes a temporary bump in the road or a defining economic challenge of the year.